glasses and the jacket for TV one of these?
Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge, bringing you our Strategy of the Week update here for December 2nd. Hope everybody had a happy holiday there for Thanksgiving, and we are getting into the full swing of holiday season now. The antithesis of December that I always like to bring up is, okay, are we getting ready for a Santa Claus rally here? We usually see some strength in commodities and at least in my tenure at the Board of Trading and the CME, we've seen a strong December market usually. But this is, of course, one of last year, falling into this one in 2020 and all that stuff. I mean, this has been a year of just unknowns and black swans and things coming out of the woodwork. So the Omicron, no N in there, it's not Omni, it's Omicron, variant has hit the waves here, shaking up the market. And the big question now is, right, how much is that going to change the geopolitical atmosphere of the world at this point in time? I hate that discussions about markets have to start going into the political side of things, talking about things in science and viruses that really have no place in talking about corn, wheat, beans, or even the S&P at the end of the day. But nevertheless, they're the forces and the things that are moving the markets. Pretty good recovery here today. It almost, with the exception of natural gas, you could say that just about everything today looked really good. Didn't start the day off that way. We were looking pretty bad for just about everything, with the exception of maybe soybeans and soy meal kind of hanging on to some of their gains from the other day. But that natural gas market continues to deteriorate. That's not a bad thing. That algorithm or that correlation we've been watching, and I've been pointing out on Twitter about natural gas and corn being correlated, trying to buy inputs. I'm actually happy to have seen that correlation break here because corn prices have remained pretty well bid, while natural gas prices are falling. Natural gas is a rough proxy for nitrogen and other inputs here. It's good to see that the cost of producing things like ammonium nitrate or other inputs for our corn production potentially could drop here now. So some of that pressure seems to be alleviating. It's going to take a while to get through the supply chain and what have you, but we've got time on our side now. We're not putting all that out on the fields right now. The winter is starting to set in, so we've got some time for the fertilizer market to come back to some relatively normal prices. I will say this, fertilizer prices are probably going to be very close to what we saw in markets like lumber. Just for a good example, went up 2, 3, 4 times the value that we saw them at last year, but then eventually settled back down, and we only really have seen about a 20 to 25% inflation of lumber costs year over year. So not to say 20 to 25% is like a little amount and that we should be clapping that, oh good, that's only, it's a new normal, right? But it is higher prices, but not to the extent of 200, 300, 400 times the price of last year. So I know we're looking at some fertilizer and other input costs here. They're up 2, 3, maybe even 4x. Those prices will very likely settle back down. But it is interesting to see that the transitory nature of inflation right now, even the Fed is starting to walk back on that language, which is something we've talked about time and time again. Markets make new normals, and good thing for capitalistic markets where we can allow free markets to correct those prices. So all that aside, let's take a look at what happened here today. The first market I'm going to talk about is live cattle. Just very briefly talk about the continuous contract here on a daily time frame, because breaking above 130 to 135, that was a big threshold we talked about before. And it was the old highs here from April 2017, April 2019. The 130 figure seemed to just be the figure we couldn't get above going back 5 years here. We have started to rip above that, potentially starting this multi-year trend or reversal. The October 2015 highs for live cattle up at 145 remain above us and probably where this market will continue to trend to. We are at the upper ends of a channel resistance right now and again, this is the continuous contract, so take it with a grain of salt. When you start to dive and dial down into the that actual February contract, you can see how, you draw a channel on a chart like this at this point, and we're nowhere near that channel resistance just yet. It happens to be right up there around that 145 figure that I pointed out in the continuous chart, and those old highs from October of 2015. I'll have to go back and look. Mine's already getting away from me. But moral of the story is that this this trend higher seems to be intact for now. Obviously, the last couple of days we've seen some fear of the Omicron variant come into play. That ended up being pretty negative for cattle here over the last year. Whenever we saw spikes in COVID and what have you, as consumer demand was always brought up as a concern, and that retail demand from a lack of restaurant purchasing, but for beef. With all that being said, the trend higher seems to be the current state of the market, and if we push above 141, onwards and upwards to 145 for that Feb cattle. Support at this time, I think, had proven itself there at 137.50. We just pulled back, a 2-day pullback here to test our old highs here from October, and certainly the high that we broke out from in November. And live cattle seems to be within a channel, inside of a channel at this point, and trending higher. So that going to be generally supportive. We like to see cattle prices continue higher, justifying a rise in input costs for cattle producers, which then helps our row crops to a certain extent as well. Oil being the other factor here for some of the crush capacity being increased, I'm sure, or some of the better crush numbers we've seen for both ethanol and soybean crush recently, because capacity is what it is. We can't increase that too much year over year, more than the producers are able to by that few percentage. And it's usually pretty constant, but we've seen very strong crush numbers. We haven't been walking back on those as you would think we would if demand wasn't there. Crude oil, though, really taking it on the chin here, down a whopping $23 a barrel here from the highs from October. Overbought conditions in the chart are certainly the situation that we were unwinding, and we were coming off more or less a very omnidirectional, with the exception of 2 or 3 months total of downside since April of 2020. So crude pulling back was the most extreme pullback we've seen. Happened to be right back into old support. Good area for the market to have bounced from, given the 50% extended longs. If you draw from the 43 highs up to the 85 high, the 65 area was that supportive area that we would have expected. And if we draw a bit of a channel on this chart, sorry, it's not the channel tool. Highs, draw it against the highs here, drop it down. Breaking below the 70 figure wasn't great, but this channel we would expect would be at least resistance on a bounce back up here for another test towards new highs in the month. So even if you're bearish crude because we've broken below this channel, hence the reason I put it up on the chart, there's probably a good chance that we'll test back to that area, if only as resistance here in the near term. Now, highs of the month are only now $2.50 away from where we look to be trading here into the end of the day, around 67 for crude, and we are a whopping $3 off, $3.50 off that low, $4.50, excuse me, off the lows at this time, which if we didn't see this kind of recovery on a day like today, this daily candle could have been a very bullish, engulfing candle to the downside. Now it looks like a potential reversal, and might be the market capitulating, given the reversal we've seen off the low of the day, and a trading back towards its highs. So back above the body now from yesterday's candle. Obviously, the first 2 days of a month, I try to look for, or first few days of a month, I try to expect highs or lows for the month to form, and you while this does look like an extreme low price is forming, it very well could be the start of a trend lower for the rest of the month of December. But watch that 70 figure on crude. If we start to break back above, there's still plenty of, $16, plenty of room to the upside from 70, right, at this time. So that supportive price action we're starting to see in crude, I think will continue to roll over and help our row crops as well, and generally a better bid here on our energy markets. So, far as our row crops go, March wheat trading back down to test the 770 to 780 area. It's our cluster of old highs that we broke out of. Could also make the case we needed to trade all the way back down here to fill this little open gap we had. That was from the bell on November 10th. We had an open gap on the bell. It gapped from a 93 biscuit pause, opened at 95.50, 795.50 to be exact, and never looked back. We've now come back to close that area, and it was an intraday area level that we had. I believe I had it on the December chart here, just to go back. A similar level that we came back and filled. What was on the continuous? There it is. I hit on the continuous contract, 781. The market came back and held that area as support. No shocker that a technical level like a gap open ended up attracting the market. And now that we've seen a technical reaction from that area, leads this trader to believe that could be the lows for wheat. Certainly the higher high and higher low day over day to start the month of December is good price action. But unfortunately, we are still entirely within price action from that decline we saw on Tuesday to end the month of December. November. So back above 824, 825, the lows that we had moved or sold off from to start end of last week and then fell through to start this week of trade, rising back above that level starts to negate any of the downside that the bears leaned into here, and would suggest maybe we're going to go back up for a test of that 840 to 850 area where we found resistance previously. The full 50% retracement off of the highs for wheat from the 874.75 highs down to the 872 area on the March contract is at 828. So at this point, I think the path of least resistance is probably still higher to test that 828 area, even if we're going to continue lower. And that area of or inflection zone on this chart again aligns with those other lows, that cluster of support and resistance. Maybe you could consider this from previously that we were holding above, and the levels we just broke down below here recently. Supportive price action, though, we would expect to see come in probably around $8 at this point. Full 50% retracement from our recent low to the nearest high is at 801. We certainly tested that level here today after getting back above $8 in the March wheat and decided to stay there for the rest of the day. So barring any major pullback tomorrow, can't rule out a move down to $8 for the wheat and then a bounce higher if it is going to continue up towards 820, 830. But barring any kind of move to the downside tomorrow, I would expect this trend in the short term to continue higher. March corn. Let's take a look at the 200 or the daily chart. Get some of those bigger technicals we traditionally follow. 200-day moving average down around 545 here. 55-day and 100-day are clustered right around 555, 557 with that 18-day moving average. We couldn't break back above it here today. I didn't like seeing the 578 area hold as resistance and us, remain below it because that 18-day moving average, when corn has been trending in the past, has been a pretty good indicator of the short-term trend. Now, ever since we started that sideways price action last May, wasn't so much the case because the market was then trying to feel out a bigger range, and any of those shorter term moving averages were just noise at that point while the market was finding the 100-day and 55-day moving averages, and even came down to test that 200-day back in September and October. 200-day moving average for corn, again, down around 545. That's rising up here pretty well. But it also happens to be right around where a full 50% retracement would be for the last swing in corn. From our lows, the lowest low we made on the chart, down around 506 in March corn, up to the highs at 596. That 200-day and that full 50% area right around 545, 550. Interesting level if the market decides to go down and test it. But corn, generally speaking, kind of started to lead the row crops off of the lows. Now we're taking a bit of a pause. Soy meal started to maybe lead the way, arguably, and that has shifted the focus over to soybeans a little bit. But that 55-day moving average starting to push above the 100-day, which happened earlier last week. That golden cross is certainly a good indicator that if we can hold support on the corn, we push back, above that 18-day moving average. I think the market is starting to signal that the trend higher is resuming, and we should expect a test of $6 or even above in the near term. January soybeans have a lot of room to go to get back up to that 200-day moving average, up at 1301 now. So beans being below that level, I think the path of least resistance will likely be for a move back up to $13. Of course, we need to clear through some resistance in the short term before we even get there. And like the corn, the 18-day moving average kind of closed right at it here today at 1244. Unable to break above it, tried to go above it here today, but today wasn't the day. I think, into tomorrow and into next week, that as a technical indicator, a close above could be the technical indicator that starts to get, fund and other bigger trend traders back in on this market and excited again. Today's 2-day reversal off of lows could very well be a dead cat bounce and a bull trap. But into the price action tomorrow and into Monday, will certainly, I think, answer that call for all of us. 55-day moving average at 1251 for the soybeans, 100-day at 1289, and that 200-day up at 1301. I think any one of those levels justifies a test at this point in time, given that soybeans have been pretty comfortable staying above $12 for the last 2 months and are struggling to even get below 1220 at this time. So we'll see. Trendline resistance against the highs was the figure that we've been flirting with and trying to stay above. We certainly broke above it there in that last push for November, and then falling back down here in December to test them, the broken trend lines, as resistance now as support. Seeing it get back above that old, the main trend line that began that ran against the highs June through July of last year. That was a pretty good close for the day. But now we want to see it push above, stay above, and maybe even take out that 55-day moving average around 1250. I'd feel much more comfortable with the rally we're seeing if that happens. So let's get into some ideas now that we've gone over those daily charts. Let's go over some ideas that for how to play this, because I think we're all looking at these charts right now thinking to ourselves, well, boy, I wish I would have started my reownership for corn when we were a bit lower. The 550 to 510 area would have felt better being long this, to the low end of the range. But now we've had a solid month of testing where support is and if the market wants to hold it. Well, so far so good. And this now kind of new level or new range we're starting to carve out. The 560 area here for March corn seems to be maintaining that support area. If we break down, so be it. I don't think you come in with 100% here. I don't think you need to be too over positioned on the board just yet. And we've been kind of conservative, certainly been more bullish than not over the last several months, but been pretty conservative with some of those pre-sale reownerships because there was a lot of unknowns here, right? Coming from all over, with whether it be COVID or Chinese demand, what have you. Now we're at the point where we're going to, and I think most would be very regretful of not having something established on the board when we do get up to $13 soybeans, do get up to $6 corn, not having something in place now to know that we have the ownership taken care of is just going to get that much more expensive. So something I'm suggesting and talking through with clients about is, if we haven't done sales that we need to re-own and replenish, getting some form of call spread on at this point in time would make sense to be ready for that opportunity through March or May of next year. This might look like, I think I was looking right away, I was looking at 1340, 1440, or maybe it was 1460, or excuse me, it was much lower than that. It was $13, 1440 call spreads here for soybeans through May. The idea being that I want to be ready and have something ready if we want to do those sales at $13 when we get up there. And by the way, this is all at finite out-of-pocket costs. So now is the opportunity to do things at what I think is at a cheaper price point than where we will be in 3-4 months if we're right about that situation. So with that being said, the 4-hour chart for soybeans at this time, little mixed. We didn't really want to see the market break below from 1181 up to highs. Ignore some of these. I'll just take them out.
Good time, right? I mean, they played at the pool, they played at the beach, even though it was 63 degrees.
Okay, so the swing here from 1181 up to highs, I really did not want to see it puncture the 61.8 line. But the truth is that doesn't break the idea that we can't head higher. It's not the best thing to see, right? That original gap down and actually not filling that level and starting to move off of it, I was pretty convinced that we were going to continue this higher. Nevertheless, the market needed to punish me and everybody else who thought that way before reversing. But because we have broken below this 1222 area, we have to be hyper aware that from the 1289 high down to lows, this 1250 area, we really don't want to see the market hold. We want to see the market push back up to 1260. And so long as it can push back up to the 61 to 65% line of the short off of the highs here in this range that we've been in, it negates the ability of the bears to break down to the negatives to the 61.8 line of the bulls. So all that being said, I am anticipating potentially the market heading up to 1260, and if it does, that is a better signal that if you don't feel comfortable getting some re-ownership done now at 1244, when we get to 1260, that's much more of a confirmation of this market moving higher. And honestly, at that point, we'll probably see some form of small pullback. I would expect that to be Monday, Tuesday, Wednesday of next week, maybe into Thursday, and then the market continue higher. Today was the outside day that broke us above that downside from last Tuesday. Higher highs and higher lows 1 day running now is a good look for the market. But again, we got resistance here at 1250, and a move towards 1260 would negate some of that in the near term. So again, I'm talking about re-ownership here that we could look at, going forward. And this isn't as much of a speculative, today isn't much of a speculator's strategy of the week. Today is really how do we maybe get positioned for future cash sales? Because I think that right now, if you're not thinking about that, you're missing the mark somewhat on the marketing side of things. May is pretty far out. Trading at 1257, not a huge premium to the January though. But what it is trading at is a massive time value premium, right? That theta is huge. 41 cents to buy a $13 call outright. That's 40 cents out of the money. And a 1440 call going for 12 cents. So we can cut our costs here down to less than $1,500 to own a $1.40 wide spread. This is about as much as I'd want to pay for something like this at this time, and the reason being is it's getting down, getting close to that 4-to-1 risk-reward ratio. And I would prefer to have had the spread on when it was more 5-to-1, reward to risk ratio. All that being said, though, I think it's still a viable strategy given that there's 141 days left on May. This gets us through the time period last year where we saw the market start to top out. And really, what's selling to 1440 calls in this strategy will be a liability down the road if we rip roar from here. But what's more important to remember is that we shouldn't worry about that short 1440 call so long as we've got the bushels, and this is true of re-ownership or pre-sale, pre-re-ownership of sales. If we were just coming in at this point for sold bushels, we might not need to, I might not be advertising selling that 1440 call against owning the $13 calls here because you don't have the bushels right in that situation to make up if the market rallies. If the market rallies here, we're planning on doing those sales at 13. If we get there, you'll own the $13 call, and at that time you can make a choice about the 1440s. And if over the next 141 days you have that opportunity to think about that, and we can think about how to take those 1440 calls off to leave the upside open if we want at that time. So all that being said, I think that it behooves us not to, for less than 30 cents of risk here, have that type of upside opportunity, especially if we're deciding and trying to play with some of the bushels in the bin at this point in time. This is a way of establishing that cost average on a hedge or a re-ownership strategy down the road. Now, if we get a little bit higher, we might be starting about some put protection or doing some risk reversal things, selling calls to forward some puts. If we want to have that type of protection to the downside, I would come in a little shorter dated on buying put protection because I think that if we're going to be heading lower, it's going to be very soon, right? Likewise, if we're heading higher, I think we'll be soon. But a call spread strategy like this at this time with some bushels in the bin is really about getting ready to do those sales if we do a rally, more than anything. So $12 puts, I would only go out through February here. It's off the March contract still, but for only 14 cents, we can get a floor in at 12. Yeah, it's only for the next 50 days, but this market, if it wants to fall apart, it's probably going to sell off a lot more than the 44 cents it takes to get down there. So I can't argue that selling or buying this $12 put, doesn't make sense at this time. Now, turning around, you can actually sell I would be looking at maybe the $13.30 or $13.40 call. We can sell a February $13.30 or $13.40 call. Let's just use the 1340s, bring in 8.5 cents at this point in time. That cuts that $12 call or put, cost in half here. So for the next 50 days, to get at least some protection in to the downside, we can cut the ownership of a $12 call down to 6 cents by selling that $13.30 call the $12 put cost down by selling the $13.30 call against it and creating that window or that risk reversal strategy at this time. Now we start to rally. That type of strategy is really for the bushels in the bin or maybe even against a long futures position because again, you don't want to be short a 13.30 call without the ability to get called away from a position here because of the unlimited risk that resembles. But 13.40 is a dollar rally almost from where we are now. So on any bushels we own or futures position that you're using against that, that's a very good, a pretty good option strike to utilize over the next 55 days to cut the cost of having floor protection in, and of course keeps you from having to have the unlimited risk of a short option at this time. All right, so very similarly here, we're going to be looking at corn. May corn. I was doing these in March, the $6 660s, but I think you can go further out and get that additional 70 days by going through May. and it still seems viable. I would push, though, the strategy a little further. I'm shooting for about just under a 20-cent cost here for an 80-cent spread. So it's going for, call it 18.5 cents. The $6 680 call spread. Spending 28.5 cents out of pocket to buy a $6 call through May. Turning around and selling the 680s, bringing in just about 9 and 7/8, but just about 10 cents there. Cuts that cost down to about 18 cents. It's a just under 4-to-1 reward to risk ratio, or a little bit better than a 4-to-1 risk reward ratio for that call spread at this time. May is trading at 5.79, so we are only 21 cents out of the money from the $6 calls going into the money, and we got 141 days on it. If you're planning on being a seller at $6 and the cash side of things, again, just like we looked at the soybeans for $13, this call spread is a pre-sale call spread against any bushels that, or reownership strategy against bushels we're planning on selling, establishes that reownership before we've let go of them, and ideally at a smaller price point than what this would call to establish that reownership in the future when we get to the point where we can do those $6 sales. And of course, I'm going off of what the board price would be at the time, because many of you, depending on your basis, you might already have that opportunity in front of you. Similarly to the risk reversal strategy we looked at for beans, affording a $12 put and selling 13.30 calls against it, I wouldn't do that for corn out through the May timeframe. Any kind of put protection, I like spending less premium or less time value on at this point. So I would be looking at something shorter dated. Again, looking at the February there, where there's 50 days of protection. This gets us through the end of the year, gets us into New Year, and takes us through that WASDE report in January, where we would expect kind of the next news cycle to begin, and we start talking about the acreage assessments. So for December corn, or March corn at this point in time, the 560 threshold seems to be where it's only 16 cents away here. For a 13-cent outright cost is actually not a terrible out-of-pocket, just flat cost, in my opinion, to pay for put protection at 560. But if we wanted to turn around and try to finance that $13 out-of-pocket cost, you can go as high as almost behooves you not to sell a 620 call against it, and bring in 7 cents and cut that cost down to 5 cents to own a put that is 13 cents away from us now, and puts a floor in generally near the lows of March corn for the month, right? For the month from going off of our month of November and December here. Again, not going to want to be short that 620 call in 55 days if we are rallying against it. So the risk reversal strategy of buying a put here, sending a call against it, it is much more, protection against the long futures position or long, cash in the bins, but doing so alongside a further dated strategy here to, for some establishing that reownership, like we talked about with the $6, 680 call spread through May. Both of those spreads end up giving you not only protection through the end of the year and into March for any kind of downside in corn, but allow you to then make the decision on getting those sales done, knowing that your reownership has already been reestablished. And looking at both of those together here, particularly for corn, you're 6.5 cents out of pocket for that downside protection, which is pretty tight, all things considered, to the market, and then 19 cents out of pocket for your reownership. You're talking about less than 30 cents to more or less have everything done you need marketing-wise through May on any kind of bushels. And again, this strategy would kind of adapt and be readjusted for as sales are done or as the market starts to move, but without picking a directional bias or trying to speculate on where the market's going to go. We can feed into both having protection for the grain we've got if we haven't sold it already, and establishing reownership and getting ready for the next move down the road. And so that pre-planning of marketing that oftentimes gets pushed to the back burner until the last minute when we decide we need to do something, this is the time to have that discussion and to look at those things. So we'll continue to monitor how those goes. Now, from more of a speculative perspective, let's go, and while the few minutes we have here remaining, let's take a dive down towards the shorter time frame charts and try to see, if there wasn't anything to do, or does it make sense to do, or get ready to position on anything here from a trading, kind of perspective. Next in the series up for corn in the March contract, 575 area is going to be key. We held that area of support this morning. It's the old highs. It's a 50% from the lows of the day through highs of the day. And it also happens to be where, on a 15-minute chart, we got a nice little trend line against lows. I would expect into tomorrow us to hold that trend line. If we do break below, I would have a very, very hard time from the swing from 562 up to 581. I'd have a hard time being a buyer at 572, which is just a 50% level. And the reason being is because from our 596 high down to our 562 low, corn is holding its 50% resistance. For all intents and purposes, this very much looks like a market that is sold off, tested into where resistance is, and maybe have rolled over today. So that is a little concerning, what we're seeing on the chart. But nevertheless, corn still has the ability to continue its trend higher. The multi-day trend was started now since the lows of Tuesday. And if that's the case, then we probably won't see corn really get below 575, 573. We'll trade up to 584. And if that's the case, now we've negated that whole idea of that there may be sellers here that are keeping us from going higher. So in the short term, going into the end of this week, you guys all know how I love talking about weekly options. Well, if you're going to speculate long in corn here, think, being a buyer on a dip here, risking less than 5 cents is one way of doing it. I don't think you need to risk more than 5 cents to the long side in the near term. But if you're going to spend that 5 cents here, you could easily get away with owning at the money, calls through tomorrow in the March corn. Not for everybody. Some of the premiums here don't really, or some of the pricing here doesn't really attract me too much. And so for that reason, I think I'm more on the sidelines there for corn than anything else. January beans, on the other hand, going down to the 15-minute time frame, actually look a little bit more constructive. And there's a few other levels we can kind of pull out of the market that we would expect to see support here in the near term. Intraday, that 1228 low we had from the days open to the highs after, 1238, 1239 is the supportive area that you'd expect to see that pull back into. Testing the high from yesterday. Kind of looks like a natural level beans would trade to before taking off towards 1255. Full 50% retracement off the lows from 1214 to the 1249 highs. We really, really do not want to see beans go below 1230 tomorrow. That's 14 cents from where we are now. That's 19 cents off the highs of the day. Very much into a Friday makes this look like a bull trap. And any acceleration lower from there, below 1220, things could get really, really ugly really quickly. A test of $12 would probably not be out of the works there. And the old lows at 1181 would certainly be threatened. With all that being said, though, a push up to 1257, 1260. After that, maybe there'd be a little bit more of a pullback. But where we went out today, this 1238 and a half, let's call it, area is really where I am eyeing for support into the overnight and into tomorrow, and then a subsequent rally while we're above 1235 up towards 1254. So we'll see if that plays out here in the near term. So again, I know today was pretty heavily into the marketing ideas, a little bit of forward thinking, and how do we get and reestablish some re-ownership ideas now when those call spreads are likely cheaper than when we would do, planning some of those sales into the future. And of course, 2 risk reversal strategies that through February, off the March contracts for beans and corn respectively, We can afford put protection that's pretty aggressively priced here. I think having a $12 floor on beans is just a nice level to be thinking about. What do we say? 560 on the corn is also a very aggressive level that even at these input prices makes the farm payout still reasonable. I know we all are calculating things out and are probably saying to ourselves, "Wow, we really need $6 corn if fertilizer trends continue where they're going." But like I alluded to earlier in the broadcast, seeing natural gas, seeing other markets back off of those highs, seeing things cool off a little bit will very likely allow for those fertilizer prices to start to correct a little bit here into the new year. Fingers crossed for everybody. And so long as we remain, with the continuous demand picture and the fundamental outlooks we're seeing on the row crop side, I see no reason why corn and bean production margins couldn't improve between now and then. The last point here, and next week, and I might do a whole video on this into the end of this week, is the corn to bean ratio. Talked about it before. We went from being very heavily weighted to favoring beans in that ratio at 2.8 to 2.9 earlier this year, now down to about 2.1, where we're more favored towards corn. And the idea of buying inputs and corn needing to maybe catch up with beans and correct that ratio a little bit and that spread has played out, and that pendulum has swung to the other extreme. So expecting that to come back towards, I don't know, maybe towards 230, 240. We'll look at a chart of that ratio spread here at another time. Because it's not the end-all be-all, and we really aren't into the acreage argument just yet. We got to get through that January WASDE, in my opinion, before we get there. And certainly the moving target that is input costs at this time haven't set anything in stone. So with all that being said, everybody, thanks for joining us here today for the Strategy of the Week webinar. Remember, it can always be reached over here at Zaner at 312-277-0110. Check out the links in the comment section, everything below, to join in on our weekly or daily newsletter, or click on the link to fill out a Cant application and join us over here at Zaner Ag Hedge to put some of these marketing ideas to play for you. Have a great day, everybody. Have a better weekend, and we'll be back with you as price action develops. Take care, everyone.